Silver just dropped 6.5% in a single trading session. After touching a fresh all-time high of $121.66 earlier in the day, the metal reversed hard and plunged to around $109. That is a swing of more than $12 per ounce in a matter of hours. And if you have been following this market, if you have been riding this incredible rally that has seen silver gain more than 50% since the start of the year, you're probably asking yourself the same question everyone else is asking. What just happened? And what does it mean? Here's the thing about parabolic moves. They do not end gently. They do not give you polite warnings and orderly exits. When markets go vertical, when gains compress into time frames that defy normal expectations, the corrections can be just as violent as the rallies. And what we saw today is exactly that. A market catching its breath after one of the most explosive runs in precious metals history. But I want to be very clear about something before we go any further. This pullback, as dramatic as it looks on your screen, does not change the fundamental story. The reasons people have been buying gold and silver have not evaporated. The dollar is still weak. Geopolitical tensions are still elevated. The Federal Reserve is still trapped between inflation that will not go away and an economy that needs support. Those conditions have not changed because silver dropped 6% in a day. What changed is that after a rally of this magnitude, some investors decided they wanted to lock in profits. They saw a new all-time high, and they said, you know what, I'm going to take some money off the table. When enough people do that at the same time, you get the kind of waterfall decline we witnessed today. It is not a sign that the bull market is over. It is a sign that the bull market is healthy enough to have profit-taking. I want to walk you through exactly what happened, why it happened, and how to think about it going forward. Because the decisions you make in moments like this, when the charts are red and the headlines are scary, those are the decisions that determine whether you end up on the right side of the wealth transfer or the wrong side. Let me start with gold, because while everyone is focused on silver's pullback, gold quietly pushed to another fresh record above $5,200 an ounce. The yellow metal rose as much as 1.3% on the session, building on a 3.4% surge in the prior session that marked its biggest one-day gain since April. Gold does not get the same attention as silver right now because its moves have been less dramatic in percentage terms. But make no mistake, gold is the anchor of this precious metals rally. And when gold keeps making new highs even as silver corrects, that tells you the underlying bid for hard assets remains intact. The catalyst for gold's strength is the same catalyst that has been driving precious metals for weeks. The dollar is collapsing. It slipped to its weakest level in nearly 4 years. And the response from the President of the United States was essentially a shrug. Speaking with reporters, President Trump said he was not worried about the dollar's decline. He described the currency as doing great and emphasized that fluctuations in exchange rates are normal. Now, think about what that statement means if you are a foreign investor holding dollar-denominated assets. The leader of the country, whose currency serves as the global reserve, is publicly saying he is not concerned about its decline. He is essentially giving the market permission to continue selling. And when the people in charge of a currency signal comfort with its depreciation, capital looks for alternatives. Gold is the original alternative. It has been the alternative for thousands of years. The backdrop is even more concerning when you zoom out. Investors have been rotating aggressively out of currencies and sovereign bonds. There is real concern about heavy fiscal spending, highlighted by a sharp sell-off in the Japanese bond market. There is speculation that the United States could intervene to support the yen, which has weighed further on the dollar. The global bond market is showing stress in ways that make investors nervous about the safety of supposedly safe assets. Gold has now gained more than 20% since the beginning of the year. It broke through $5,000 an ounce for the first time this week. These are historic milestones that would have seemed impossible just a few years ago. And the fact that gold keeps climbing while silver corrects tells you that the move into hard assets is not just about speculation. It is about a fundamental loss of confidence in paper currencies and government debt. Markets are also factoring in the possibility of a more dovish Federal Reserve. There is speculation that BlackRock's chief investment officer, Rick Ryder, could succeed Jerome Powell as Fed chair. Whether that speculation proves accurate or not, the perception of potential policy shifts is influencing bond traders in their bets on easier policy. Lower interest rates tend to favor non-yielding assets like gold and silver. That expectation is providing support even on days when prices pull back. The options market is telling a similar story. Implied volatility on COMEX gold futures has reached its highest level since March 2020. That was the pandemic crash. The market is pricing in the possibility of big moves in either direction, which tells you uncertainty is elevated. When uncertainty is high, precious metals tend to find buyers. Now let me talk about silver specifically, because the pullback deserves a detailed explanation. Silver touched $121.66 for a fresh all-time high. Then it reversed and plunged to around $109, a decline of 6.5% in a single session. That is the kind of volatility that silver is famous for. The metal has earned the nickname the devil's metal for exactly this reason. It gives you the highest highs and the lowest lows of any major commodity. The immediate catalyst for the pullback is straightforward: profit taking. After a rally of more than 50% since the start of the year, after gains that compressed years of normal returns into weeks, some investors decided to cash out. They hit the sell button. And in a market that had gotten stretched, that selling fed on itself. The CME Group moved to raise margins on silver contracts. When the exchange raises margins, it forces traders using leverage to either put up more capital or reduce their positions. That deleveraging creates selling pressure. It is not a fundamental change in the story. It is a mechanical response to elevated volatility. Chinese silver funds paused trading amid concerns that current pricing had become stretched. We talked about this in previous videos. The premiums in China had reached unsustainable levels. When domestic investment vehicles cannot keep up with the surge in demand, they have to pause to protect investors from buying at premiums that do not reflect underlying value. That pause removes a source of buying pressure, at least temporarily. All of these factors combine to create the conditions for a sharp pullback. But I want to emphasize something important. None of these factors represent a change in the fundamental story. Profit taking is normal and healthy in a bull market. Margin increases are standard responses to volatility. Fund pauses are temporary measures that get lifted when conditions normalize. An analyst at Merrick's made an observation that I think captures the bigger picture perfectly. He noted that rising U.S. debt levels and the gradual fragmentation of the global trade system into regional blocks are encouraging investors to reduce exposure to a U.S.-centric model and increase allocations to precious metals. That structural shift continues to support longer-term silver demand despite short-term corrections. Read that again. Structural shift. This is not about day-to-day trading. This is about a fundamental reorientation of how global capital thinks about risk and safety. When investors are reducing exposure to a U.S.-centric model, when they are increasing allocations to precious metals as a hedge against the fragmentation of the global system that creates demand that persists through corrections. The geopolitical catalysts have not gone away either. President Trump has urged Iran to resume nuclear talks, warning that any future U.S. strike would be far more severe. In response, Tehran has threatened retaliation against the United States, Israel, and their allies. This back and forth creates uncertainty that supports safe haven demand. When world leaders are exchanging threats about military action, investors buy gold and silver. That dynamic has not changed. Concerns over the independence of the Federal Reserve continue to weigh on sentiment. The administration is pursuing a criminal investigation into Fed Chair Powell and considering changes within the institution. Whatever your political views on the situation, the market impact is clear. Uncertainty about the future credibility of U.S. monetary policy supports precious metals. When you do not know whether the central bank will remain independent, you hedge your bets with assets that do not depend on central bank credibility. The dollar is struggling to regain sustained momentum, and as long as the dollar remains weak, silver's appeal as a hedge against currency risks remains strong. These are the conditions that have driven the rally. They have not changed because of one day of profit-taking. On the macroeconomic front, the Fed kept interest rates unchanged in the 3.5% to 3.75% range. They acknowledged that inflation remains elevated and economic uncertainty is still high. Recent labor market data point to ongoing resilience, but stabilizing unemployment and moderating job gains support a cautious stance from the central bank. According to analysis from Commerce Bank, the Fed is in no rush to deliver further rate cuts unless economic indicators deteriorate meaningfully. That policy stance, stable rates with a bias toward weighting, creates an environment where precious metals can thrive. The Fed is not raising rates to combat the rally. They are sitting on their hands, while gold and silver continue their advance. The opportunity cost of holding non-yielding assets remains manageable, and the uncertainty about what comes next keeps the safe haven bid alive. Let me now address the question everyone is asking. Is this a buying opportunity or a warning sign? The honest answer is that it depends on your time horizon and your risk tolerance. If you are a long-term investor who believes the structural factors supporting precious metals will persist, then a 6% pullback after a 50% rally looks like an opportunity. You're getting a chance to add exposure at prices that are meaningfully below the highs. The fundamental story has not changed. The correction is technical, not fundamental. But if you are a short-term trader who is not prepared for more volatility, this pullback might be the beginning of a deeper correction. Markets that go parabolic can correct just as dramatically. A pullback to $100 or even $90 would be entirely consistent with the kind of volatility silver has historically exhibited. If that kind of move would cause you financial or emotional distress, you might want to wait for more clarity before adding to positions. I want to give you a framework for thinking about this that separates the signal from the noise. The signal is the fundamental backdrop: dollar weakness, geopolitical uncertainty, Fed policy constraints, central bank buying, structural shifts in global capital allocation. All of these factors point toward continued demand for precious metals over the medium to long term. The noise is the day-to-day volatility. Profit-taking, margin calls, fund pauses, headline-driven swings. These factors create opportunities for disciplined investors and traps for emotional ones. The key is to not let the noise obscure the signal. One analyst noted that the current pullback appears largely driven by technical adjustments and profit-taking after an exceptional rally. Fundamentals, supported by geopolitical risks, political uncertainty in the United States, and persistent U.S. dollar weakness, continue to argue in favor of sustained interest in silver over the medium term. That assessment matches my own reading of the situation. The pullback is real. The volatility is real. But the reasons for owning precious metals have not changed. If anything, the concerns that drove investors into gold and silver are intensifying, not resolving. Let me talk about some specific levels to watch, because having a framework helps you make decisions without getting swept up in emotion. Silver pulled back to around $109. The next support level below that is around $100, which is a major psychological barrier. If silver holds above $100, the bullish structure remains intact. A break below $100 would suggest a deeper correction is underway and would warrant more caution. On the upside, the all-time high of $121.66 becomes resistance. If silver can reclaim that level and close above it, that would signal the correction is over and the rally is resuming. Between current prices and that high, there will be plenty of choppy action as bulls and bears fight for control. For gold, the $5,200 level is the new reference point. The metal has been making higher highs and higher lows, which is the definition of an uptrend. As long as gold holds above the $50,000 level on any pullbacks, the bullish case remains strong. Gold tends to be less volatile than silver, so corrections are typically shallower in percentage terms. I want to address something that I know some of you are thinking. You are looking at this pullback and wondering whether you missed the move, whether the best gains are already behind us, whether buying now is just catching a falling knife. Here is my perspective. Nobody knows where the exact top will be. Nobody knows whether silver will correct to $90 or rip to $150 from here. What we do know is that the conditions supporting precious metals have not fundamentally changed. We know that corrections in bull markets are normal and healthy. We know that the biggest gains often come after the biggest pullbacks because the pullbacks shake out weak hands and set up the next leg higher. The question is not whether you can time the exact bottom. The question is whether you want exposure to precious metals as part of your overall portfolio. If the answer is yes, then periods of weakness are opportunities to build or add to positions at better prices. If the answer is no, then it does not matter what silver does because you are never going to buy anyway. For those who want exposure, consider scaling in rather than going all in at any single price. Buy some now, reserve some for potential further weakness, and accept that you will not catch the exact bottom. This approach gives you participation in the upside while leaving room to add if prices fall further. The volatility we are seeing is the price of admission for this kind of move. You do not get 50% gains in a month without also getting 6% drops in a day. The two go together. If you want the smooth, gradual appreciation of a bond portfolio, precious metals are not for you. But if you can handle the volatility and you believe in the fundamental story, moments like this are when positions get built. Let me zoom out and give you the bigger picture because I think it is important to understand where we are in historical context. Gold has gained more than 20% since the start of the year. Silver has gained more than 50%. These are returns that most investors do not see in a decade, and they have happened in less than a month. That kind of performance is extraordinary. It is also unsustainable at that pace. Markets do not go up in straight lines forever. They advance, they correct, they consolidate, and then they advance again. What we are seeing right now is the correction and consolidation phase. It feels scary in the moment, but it is how healthy markets function. The reasons for the rally remain valid. The dollar is weak and getting weaker. Geopolitical tensions are elevated and not resolving. The Federal Reserve is constrained by inflation and uncertain about its own future leadership. Central banks around the world are accumulating gold. Industrial demand for silver from solar, EVs, and electronics continues to grow. None of these factors have reversed. What we are experiencing is the market catching its breath after an extraordinary sprint. That is all. It is not a collapse. It is not the end of the bull market. It is a pause. The investors who make money in environments like this are not the ones who panic at every red candle. They are the ones who understand the difference between noise and signal. They are the ones who have a plan and stick to it. They are the ones who use corrections to add to positions rather than reasons to abandon their thesis. I want to hear from you in the comments. Are you looking at this pullback as a buying opportunity? Are you staying on the sidelines waiting for more clarity? Are you taking profits after the incredible run? There is no wrong answer because every situation is different. but sharing your perspective helps others think through their own decisions. The next few days will be important for determining whether this is a shallow correction that quickly resolves or the beginning of a deeper pullback. Watch the key levels I mentioned. Watch how silver behaves around the $100 mark. Watch whether gold continues to hold its highs even as silver corrects. The interplay between the two metals tells you about the health of the overall precious metals rally. For now, the fundamental case remains intact. The correction appears to be driven by technical factors and profit-taking rather than any change in the underlying story. The conditions that drove investors into gold and silver continue to support demand. And the concerns about currencies, debt, and geopolitical stability are not going away anytime soon. Markets always find ways to shake out weak hands. That is what they do. They make you question your thesis at exactly the moment when you should be most confident. The 6% drop in silver feels scary. The red candles look threatening. The headlines about crashes and reversals create fear. But if you understand what is actually happening, if you see through the noise to the signal beneath, you recognize this for what it is, a normal correction in an extraordinary bull market. Stay calm, stay disciplined, and remember that the market's job is to transfer wealth from the impatient to the patient. Make sure you are on the right side of that transfer. If you made it this far, hit that subscribe button so you do not miss future updates. I read the comments, and I genuinely want to hear what you think about this pullback. Is it an opportunity or a warning? And as always, the necessary disclaimer. Everything in this video is my perspective, shared for educational purposes only. I'm not your financial advisor. I do not know your situation. Nothing here constitutes financial advice. I'm not telling you to buy or sell anything. Think for yourself. Do your own research. Consult with professionals who know your circumstances. And make decisions you can live with regardless of what the market does next. Stay curious. Stay disciplined. And I will see you in the next one.